Chapter 15. So in Chapter 15, we're going to look in detail the different ways that the government can intervene to get out of a recession. The same techniques can be used if we're in an inflationary output gap, or what we could call as a boom, to make sure that we don't suffer too much inflation. So essentially in this chapter, we're going to learn the different techniques. There is no clear-cut winner. In some instances, in some countries, fiscal policy will be superior. In some other instances, some other countries, monetary policy will be superior. So I'll just kind of go through them generally. And then afterwards, might have a short video that kind of compares and contrasts both of them. But generally, you should start getting an idea of what advantages each of them have and what disadvantages each of them have in this whole process. So let's go through this a little bit. So we're going to look here in this chapter on the influence of monetary and fiscal policy on aggregate demand. So we examine in more details the government's tools to influence the position of the demand curve. How do these policies affect short-run economic fluctuations, and how to close output gaps? So the monetary equilibrium, which we'll look at for the first time here in this chapter. It's covered in, I think it's chapter 10 in the textbook, but it has different things on the axes, and I didn't think it makes that much sense, so I'm covering it here for the first time. It's going to show a relationship between money supply and money demand, and the interest rate will come into play. So here we're going through Keynes' theory that the interest rate adjusts to bring money supply and money demand into balance. How does this work? Well, first off, if we do a little review here, we saw that the Bank of Canada can alter the money supply using two methods, which is either changing the bank rate or open market operations. We saw that the main one that they use is changing the bank rate, or the main statement, but there is still a lot of open market operations that happen before and after this event to kind of keep things on target. So if we look at this, we see that we have a certain level of money supply for a certain interest rate, which is a quantity fixed by the Bank of Canada. Here, the thing that was noted on the previous slide, and I want you guys to keep in mind here, is this level of money supply, this money stock, is dependent on what the Bank of Canada decides through its short run open market operations and changing the bank rate. But also the money creation process with the banking system does have an impact. So this money supply may move slightly right or might move slightly left, even if the Bank of Canada doesn't desire it to do so, just based on if banks decide to keep more or less reserves. Okay. The money demand is, we see there's many factors that influence the money demand, but the one that we focus on here is the interest rate. Because the interest rate measures the opportunity cost of holding non-interest bearing money instead of interest bearing bonds, an increase in the interest rate reduces the quantity of money demand. So if I look at it here, if interest rates are very high, I'm going to want to keep as little amount of money as possible as cash or cash equivalent, so money in my checking account. If you can get like 30% on bonds, why keep money as cash? You're giving up a lot of interest. But if interest rates are very low, like 1% or something else, you could keep a good percentage or almost all of your income, all of your wealth in cash, and you're not giving up all that much. So you're going to keep more money as cash or in a checking account if the interest rates are low. But as the interest rates go up, the opportunity cost of giving up that interest gets higher and higher. Therefore, you keep less and less money. Other determinants of money demand that may shift the money demand is because we demand money for transaction purposes and for precautionary purposes. So the other week, the transmission on my car broke, so I was not expecting to pay that, but I was happy to have some money left in my bank account to pay off that bill. I was going to use that money for something else, but that project got put aside for now, and I'm using that money for precautionary demand. Otherwise, transaction demand is like buying groceries, buying anything else that you expect on a monthly basis. You keep some money easily available for those reasons. So for a given interest rate, you're going to keep a certain amount of both, and you will increase the dollar value. For a given interest rate, an increase in the dollar value of transaction causes demand for money to increase. So the increase in the dollar value of transactions that you have to do for your groceries or for unexpected breaking of a car can be to the fact that the price level has gone up, or that you're simply undertaking more expenses. So that graph that we had earlier on, or that we'll have over here actually, has money supply and money demand on it. And we could see that leads to an equilibrium interest rate. What's mentioned on the previous slide, and don't get too fussed about this, but I personally like to say that this is real money demand, and I divide it by the price level just to say that this is my real money supply, this is my real money demand. But if you call it the way it is here, I'm fine with that. I just like to have that these two curves aren't continuously moving year after year, because we've had 2% inflation, so they're always moving. There's a little bit more money supply, there's a little bit more money demand. I like it that it's actually just real factors that are changing. So if for some reason people demand more money because they're wealthier or something else, well, it's going to make the curve shift. Or if the central bank decides to drop the interest rates, well, so on and so forth. So what we have to notice from this slide, though, is that money supply and interest rates are linked. Actually, if money supply goes up, interest rates are going down. So money supply and interest rates move in the opposite direction of one another. If money supply goes up, interest rates go down. And this is why we'll say that monetary policy doesn't matter whether you start with interest rates or start with money supply. If I say, well, I don't want this equilibrium interest rate anymore, I want to go down here. Well, as soon as I do so, and I set a lower interest rate, a lower bank rate, a lower target rate in the overnight markets, it's going to lead to a situation that for a certain amount of time we have an excess money demand. We have people that want to borrow more, we have a lower interest rate, banks are willing to lend more, so it's going to lead to more money creation as they decide to lend more money, and the money supply will adjust afterwards. So it doesn't really matter if it's interest rates or money supply that adjusts first, they will move in opposite directions. So if ever you see anything that says like, expansionary monetary policy, this, and then between brackets, this, it's just to say that they move together. Whereas when we're going to talk about fiscal policy as an increase in government spending or decrease in taxes, if we're expanding the economy, they don't necessarily have to happen together. You can increase government spending without decreasing taxes, but they don't have to move in the same direction. Whereas these two are linked. Okay. So what happens if you set the interest rate greater than the equilibrium interest rate? Well, same intuition as basic supply and demand. We'll have that situation there. If we have a higher interest rate, we're going to have an excess supply of money relative to demand. With an excess supply of money, this surplus of money puts downward pressure on the interest rates, because you'll have more and more people wanting to buy bonds, and as more and more people buy bonds, it's going to lower its yield, and it's going to drop interest rates till we reach this point here. Okay, unless we're not allowing the interest rates to fall because we've set a higher interest rate and we're the Bank of Canada, well then it might actually be the money creation process that's going to lead to a shift here. So unless there's an actual event that's happening, we will always converge to this equilibrium. Otherwise, if there's an expansionary or contractionary monetary policy, then we'll observe actual changes in the interest rate. So now that we've understood a little bit more how money supply and real interest rates work, and how they're linked, inversely linked, we're going to look at monetary policy. So the whole big thing from this discussion here is understanding what influences money supply, what influences money demand, and this idea that both of them are linked. If you could understand that, then you're ready to move on to the next step.